So where we are is where we left off in the last class is we had done an as-is valuation of SBUX. And just as a heads up of what's upcoming, you're going to have 2 assignments this week. So Wednesday, you're going to have an in-class extra credit assignment that you'll have to complete in class. It won't be due at 5 p.m. It'll be due at the end of your class time. You'll have approximately 30 minutes to do it. It will be for 2% of your semester grade. And basically, if you don't do it, it doesn't hurt you. And if you do it, it can also help you. Okay, so it doesn't really matter. And there's no ability to make up, in my class, an extra credit assignment. So if you're out for a job interview or just not feeling well, you just don't get the extra credit, because extra credit can only help, it can't hurt you. And that's the whole point of extra credit. So again, it's in class on Wednesday using the model that we're going to finish off in class today, right? So on a company to be determined, because I told you it'll take 3 weeks to do the first model, we actually did it in 2. It'll actually take you 30 minutes or probably less to do valuation model 2, which we'll show in class today. All right, Friday is the second group project. It will be on YUM. That project is 3/4 of your group project that you're going to do at the end of the semester. So as of today, we've covered 3 of the 4 sections of the group project. We have covered EIC, we have covered the historical analysis, the ROIC tree and the CFI analysis, and we have covered the valuation, which we'll finish up in class today. So you're going to practice doing all 3 of those on YUM by Friday. You'll turn it in as a group. It'll be minimum 1,000 words, but you got to cover all 3 sections, so that shouldn't be a problem. And you got to use all the data on YUM. So for example, in the EIC, you're going to have to do a beta analysis. You're going to have to do a 5 forces. You're going to have to do an industry spread based on operating ROIC and WACC. You're going to talk about competitive advantage. Then you're going to do a historical ROIC tree analysis on YUM and a historical CFI analysis on YUM. Then you're going to turn in 4 valuation files for YUM. You're going to turn in an as-is, a bull, a bear, and a target with a write-up of your changes of assumptions across all 3. So we're all going to do YUM together. This is our dry run. Okay? And so as I said, this is 75% of your group project. You're going to practice doing it in class or as your group project this week. Everybody will turn that in by Friday, 5 p.m. Eastern Standard Time. So this is no ability to work on it over the weekend. You can only do it during class or only do it during class time this week. So that is the first project. And the second project that are due, and then we'll obviously cover YUM next Monday, and then the midterm 2 is coming up the following Wednesday. Midterm 2 will be a qualitative midterm. So people have been asking about that, which means you want to do formulas. You're just basically going to be tested on, do you understand the math that you've calculated and what it means? So it will be essay questions and multiple choice.
Is that at home?
It's going to be allowed to be taken at home, but it will differ by section. So every section will have a different midterm exam with different questions, and you'll have to take it during class time just like midterm 1. Okay, so essentially that's what's coming up in the near future. So today, what we have to start out with is we need to do a couple more tweaks to our SBUX valuation model, which will be critical, and then we're going to pretty much finish almost all of the model. And that model, with these tweaks we're about to do, is the model that you're going to use for the assignments coming up this week, including YUM, which you can start on as soon as the end of this class. So, a lot to cover. Let's go ahead and get started. So, here's the deal. Where we left off with the SBUX model, which is on the screen here, is we looked at basically how SBUX was created as of the date about a week and a half ago. And what we want to do is 2 assumptions we made is we kind of left the growth rate alone and we kind of took a swag at the G. And so what I want to do today is I want to be much more specific about how we estimate a G and a growth rate and to some degree an EBITDA margin than we were before using external data. So I'm going to reach ahead to content we haven't covered yet, which is the 4th section of this class when we talk about multiples. All right, so we haven't gotten to multiples yet, but 2 things that are going to be talked about in multiples is multiples are basically an expression of the key value driver formula rearranged. What you're going to find out is that if we rearrange the key value driver formula, we can get a PE ratio formula. We can get an EV to sales or EV to revenue multiple formula. We can get an EV to EBIT or EBITDA formula, right? And we are going to do that, okay? And specifically by creating those multiple combinations of the rearranged formula, we have a result, the actual observed data in the marketplace. And what today we're about to do is we're going to work backwards to, for example, solve for a G. And we're going to solve for an EBITDA margin. So where we took a swag on it before, we're actually going to use observed data today to get a more realistic view as part of our as-is. So to be specific, here's where we're going to start. I would suggest that you save the file that you turned in and create a new file for today. And I'm going to call this the as-is. Finishing off the as-is for SBUX. I'll save that. Now, here's what we're going to do. First, we had estimated a G and a margin. So I'm going to tell you that sitting in plain sight, if we take our estimated, this is what you want to start adding, estimated enterprise value to sales or revenue ratio, and you take your enterprise value divided by EBIT ratio, that will get you an estimated EBIT margin for, can't spell today, for the firm. And specifically, the estimated enterprise value to sales and enterprise value to EBIT we're looking for are in 2020. So make that yellow. So here's the deal. If we go to Bloomberg and we go back to SBUX, US equity, and we go to the EEO screen, there are two tabs on the EEO screen, or two sections. The top section is the analyst data. The bottom section, which you can minimize, are the trading multiples based on these forecasts. So what will matter when we talk about multiples is we care about forward multiples in this class much more than historical multiples, because we are trying to predict future cash flows to get a valuation. We don't care about historical cash flows because they don't affect our valuation. Therefore, forward multiples. You can't use another data service to get multiples to do these assignments because they don't have forward multiples. And we need forward multiples. So specifically, what we're going to talk about is how FY2, the second forward year, is more standardized. So I'll show you in Bloomberg for SBUX. This is the last year, actual. This is the first forward year. This is the second forward year. This is the column that we're going to use. Right now it happens to be 2020, but it could change by company and change by time of the model. The reason why the market uses the second forward year is because the first forward year is a combination of actual data and forecast data. So for example, right now it's the end of March. Okay, when was the Ides of March? Random question. We passed the Ides of March? Anybody remember their Shakespeare? Anyway, it doesn't matter. We're at the end of March. And SBUX, as you can see, reported their data September 2019. So basically, we have 6 months worth of actual SBUX data, and we have 6 months to go of forecast data that's sitting here in this forward multiple for 2019. So what I really care about is the first clean year that's all forecast, FY2, which is 2020. So that's the column that we're going to use. And right now, in 2020, you can see this here in the bottom of the page, SBUX EV to sales, also as EV to revenue, is trading at 3.31 times forward 2020 sales. Okay, so you take today's EV divided by the forecast for 2020 revenue, you get 3.31. That's the number we're putting in here. Then EV to EBIT in 2020 is 19.28. Now, in an ideal world, you want to do these multiples at the same time you're doing the rest of your valuation, because these multiples are based on current share prices, and if the share price changes dramatically, then you're going to get some weirdness in your valuation model. Now, I am being incredibly lazy today because over the last week and a half, Starbucks stock price is virtually unchanged, right? So I'm going to use today's multiples with the model we built a week and a half ago. However, it would have been in our interest to actually go to the EEO screenshot a week and a half ago and look at the trading multiples at that time, right? So again, you want to sync up your multiple analysis with your valuation and do them at the same time because multiples are based on current share prices, right? I'm, again, for purposes of today, I'm shortcutting this. I'm not doing it. I'm just going to use the data that's on the screen because it's not going to make that much of a difference, and it's really a process class. So back to this. Here's what I'm going to do. If you take EV to sales and you divide it by EV to EBIT, you get a forecast into perpetuity EBIT margin. So here's what I know. The EBIT margin that the analysts have to use in their growing perpetuity formula is 17.2% because that's the only way that the math works, right? And again, you might be saying, well, gee, why is this way? We're going to get to this in about 2 weeks, right? So just kind of trust me that when we get to it, this is part of the derivations of the rearranged math that we're going to do. We can solve for an EV to EBIT by basically taking EV to sales and dividing by EV to EBIT. So that's our estimated EBIT margin. All right, so here's where this matters, 17.2%. If we go to our ratios, M is the perpetuity period. EBIT margin is row 9. So M9, that number, which in our model right now is 17, should be 17.2. So here's the deal. We weren't that far off a week and a half ago when we kind of swagged it and we kind of let the year 3 margin be the perpetuity margin. But I want to be more correct, so I need to make that number 17.2. Now you notice that cell's not yellow, which means I can't change it directly, and it's a result of the two above, EBITDA and depreciation. So what you'll see for companies is the depreciation rate for companies like Starbucks doesn't change dramatically over time. Now, if they do, you can also adjust depreciation, but primarily what we'll probably adjust is our EBITDA margin to get this to be 17.2. So given a 5.3 to get to 17 instead of 22.3, I need to make this 22.5. So I'm now matching, this is the perpetuity field EBITDA margin, or EBIT margin, and this is the EBITDA margin that creates it, to the observed multiple that I see in the real world of 17.2%. Questions about what I just did? Yes, sir.
Why would that be done for 2020?
Why wouldn't it be done for what? 2020. You could do it for 2020 as well. We did it for 2020 because this is the second forward year. Sorry.
I'm saying in the ratios.
Oh, because we're doing it based on the perpetuity. So the whole point is, and this is why, in a way, it matters, because we're doing today's EV to EBIT, which is primarily the enterprise value. And the reason why this is so important, you'll see in a minute, is if you do look at our valuation tab, and you look at the equity valuation for Starbucks, over 80% of the value is the perpetuity period. So getting these 4 numbers that go into the growing perpetuity more right is probably more important to a valuation, because slight changes in these numbers has huge impacts on the continuing value period. And so that's what we're really trying to get to here, is trying to approximate as best we can what those growing perpetuity assumptions are that the market had been using, because we're backing into it. And so again, it's a current EV, which present valued is what we're basically doing here. We're just replicating that on a present value basis. Yes?
Did you change the 22.3 to 22.5?
I did.
On the assumptions tab or the ratios tab?
Well, what I did was I solved for it on the assumptions tab based on these 2 numbers, because we're going to change as we update companies. And then I typed in, to get that to be 17.2 on the ratios, I typed my EBITDA to basically make that 17.2. So I made the EBITDA 22.5.
So you just typed it straight in, you don't need like...
Typed it in. That's why we kept it in yellow. And then the final choice I had to make is, okay, this is where the analysts ended up after year 3. This is the perpetuity in year 6. Do I really think I need to dramatically change years 4 and 5? The short answer, probably not. Because if the analysts see them at 22.3 and the perpetuity is 22.5, like, you can put a 22.4 in the middle there. It's not going to probably change the valuation too much, but nonetheless, we'd have to figure out 4 and 5. But with Starbucks, it's not that dramatically different. Other companies, it could be. By the way, when we did this, that changed the valuation a little bit, but not too much. That's why I'm not going to worry about that one too much. However, here's the next piece. The other big assumption we took a swag at was the G. And this one has a big impact on the company. And right now, we just kind of guesstimated 3.9 because we kind of guesstimated the revenue. So do we change the G or do we change the revenue? What I'm going to tell you is we can actually start with the G, and then we can back solve for the revenue growth rate. So here's how we do this. I'm going to show you a slide in the future reading, but this is the derivation for enterprise value to EBIT. It's how you take the key value driver formula and rearrange to get out enterprise value to EBIT. Okay, that's what I'm saying. Later classes we'll talk about that. That's how you can actually create these multiples. So here's the thing. The enterprise value to EBIT multiple needs 4 things. We need to know a tax rate. We need to know a G. We need to know an ROIC. And we need to know a WACC. So in our model right now, we know the EV to EBIT. We know the tax rate. We know the WACC. We have a good assumption for ROIC. So all that I need to do is I can solve for the G that makes it come true. So last week and a half ago when we did G, we just said, let's just kind of work a G that gets to the share price. Here, I actually want to use the math and the multiples to figure out what the G really should be. So there are 4 parts of this formula. I like to, now they're already there in our model, but I like to put things all in one place. And so I'm going to put it at the assumptions tab, even if we're not changing them here, mainly because I like to see the 4 parts of the formula so if I get some really weird math going on, I can kind of see what numbers look odd when I'm actually trying to replicate these numbers. So said it another way, I need a continuing value G from multiples. And this is what I'm going to be solving for. I'm going to need a continuing value tax rate. This one is going to come off the ratios tab as my 2024, which is my continuing period tax rate, which is row 10, so M10 off the ratios. So it's 21.8%. Okay. I'm going to need a WACC. So my continuing value WACC right now, I'm just going to use the same WACC we had at the top of the page. And again, you can either use the one in the formula I'm about to do, or I just like to put it all in one place. There's my WACC. Not changing the WACC, I'm just reusing the number I already have. And then the final number is we need the continuing value ROIC, which again is B6. That's what we're using in our model. So here's the deal. So this is the market. I'm going to put in insert. This is the market, and this is the model. So for EV to EBIT, the components are down here. The formula is right here. So what I'm going to do is I'm going to put in this formula with these numbers to say what our model would predict our EV to EBIT to be in cell D20. Right? So to get the order of operations right, equals left paren 1 minus the tax rate. The tax rate is C24. Right paren times left paren 1 minus the growth. That is C23. Right now it's 0. Divided by the ROIC, so that's C26. Right paren. Then I take all of this, so at the beginning, a left paren, and at the end, a right paren, and I divide by left paren, the WACC minus the G, so C25 minus C23, right paren, hit enter, and that gets me 10.02.
Would it be C24 minus C23?
WACC minus G. So WACC is 7.8 C25 minus G C23. Okay, so So that is the formula, the rearranged formula, again, which is content we're getting into the book in a couple weeks. So I'm just advancing it here for purposes of getting the data and the model complete. But basically, that would be what the model, based on the assumptions we have in the model, would say the EV to EBIT should be. So what I really want to do is I know the G can't be 0. So I'm going to estimate a G using the formula. So here's the deal. What if I put in 3%? Well, that gets me an EV to EBIT of 15.17. So obviously the market's using a G. Oh, not this one. The market's using a higher number than 3%. So 4%. Well, that would be 18.7. So it's got to be higher than 4. So 4.1. Now I'm getting close. Home number. A couple decimal places. So 4.13. Nope, wrong one. 4.13. There we go. So somewhere around 4.13%, plus or minus a basis point, is basically going to be the G that the market is using. When we did SBUX a week and a half ago, we actually used a G of 3.9. That was our arbitrary G. So we weren't too far off. But now what I'm going to do is I'm going to put in the 4.13, and that's going to get me to a $76 share price. Now again, the as is, I need to be within $1 of the current share price. So if you think about it, there's 5 key numbers I'm trying to simplistically start with. We had WACC, we had G, we got those 2 in. Right? We needed a EBITDA margin. We think we have a more realistic EBITDA margin. We needed a tax rate. We got that in. So the last one left are just these 3 revenue numbers. So basically what the market is telling us is they're not using 8% growth rates in years 4, 5, and 6. That's a little bit lower than that. So now, instead of trying to figure out a G and a growth, I know the G, so I can back into the growth. So what if I did 6%? I'm now back within $1. So again, when we swagged it, we said, well, 8% growth and a little bit lower G. Now we're saying a little bit higher G and a little bit lower growth rate. We weren't too far from the range, but obviously you can see the G has a very big impact on the valuation of the firm, and that's a number you don't want to swag too much, so I want to back us to back solve. This is the complete as-is model that you need to basically do your assignments coming up. Questions?
Can you go back to your assumptions real quick?
Yes. Any particular one you wanted to look at?
Yeah, right
All right, while he's looking at that, any other questions? Yes, sir.
Is this model maybe assignment class website?
So the preview of the homework or the extra credit assignment class is using this model, which has all these things into it. I'm going to give you another company, and then you're going to repeat everything we just did with that company in 30 minutes or less. Yes. Hold on, one at a time. Well, because when we were at 8%, that's why we switched the growth rate from 6 to 8, or 8 to 6. It's because 8% in the out years, I wasn't within my dollar range. But that was the point. We had to get within $1, and last week we were swagging the EBITDA margin because we were just kind of leaving it alone. We were swagging the G, and we were swagging a growth rate. What we're doing today that's different is we're actually using the multiples to get a more realistic EBITDA margin. That's what the math says it has to be. We're using the multiples equation to get a G. That's what it has to be. And we're therefore only swagging the revenue growth. And we're kind of backing into the revenue growth. And the revenue growth, like I said, we could be 7.65, but somewhere around 6% in the out years is what we would expect. And by the way, earlier in the semester, when we talked about regression to the mean and competitive advantages, it's probably unrealistic for a company to maintain 8% growth rate longer term anyways. So this is probably realistic, much more so than what we had originally done. Yes?
How do you solve for C23 on your assumptions?
C23 is the key value driver formula rearranged, that comes from the key value driver formula rearranged. It's the G that you just back solve for that makes these two numbers almost exact. That's what you're trying to do. So we're basically back solving for a G. That's what we had done. Okay. All right. So continuing on. So what we have now just done is we have completed what I'll call a more realistic as-is valuation for Starbucks. All right. So your next step in this class is to create 3 more Excel files. All right. And the Excel files are going to be called the bull, the bear, and the target. So let me be more specific. Let's start out with the target. If you go back to Bloomberg and you type in ANR, these are the sell-side analysts that are covering Starbucks today. There are 33 of them. You'll notice that these sell-side analysts have a target stock price. The target stock price is a 12-month target stock price. So the idea is within the next 12 months, we think realistically Starbucks should trade at this price based on our cash flow intrinsic valuation. They put that number in. There is disagreement. Not everybody agrees on the assumptions that are in their spreadsheet. That's the real world. So what Bloomberg does is it takes the guesses, of which today there are 24. It averages the target stock price guesses. You can see the scrollable list. And the average of all the guesses is $69.85. The price of Starbucks right now is $72.04 when the screen was loaded, which means that based on 12 months from now, the wisdom of the crowd analysts think that Starbucks stock price is actually going to decline 3%. Because in the last 12 months, Starbucks stock price appreciated by almost 31%. So if I can translate what I'm seeing on the screen, what the analyst basically said is Starbucks stock price probably went up too much last year, and they're probably fairly valued, and there's not a lot of upside in the next 12 months in Starbucks. That's basically what the analysts are saying. And that's why you can see there's a lot of holds and one sell, because people are saying Starbucks is probably very fairly valued, and it's not undervalued. So there's not a lot of opportunity in Starbucks if you're jumping in today. Okay, that's the way to interpret this. Now, there's also not unanimity because we're predicting the future. And you can see that some analysts, here's one that thinks they could be at 79, and here's some analysts that think it should be at 56. So the point of the story is, even the analysts don't agree on what the price should be. So let me tell you about the buy-sell holds. So a hold generally is plus or minus 10% of the current share price. Okay, and we're going to use that standard in our class as well. And the idea of a hold is it's kind of like a trading range. So a company's going to bounce around. I don't want to get you to put a whole bunch of money into stock that's going to like go up 3 or 4% just because it's bouncing around in a trading day. Like that's not a good long-term reason to be in. So basically, if you're not within 10%, or if you're within 10% of your target of the current stock price, it's called a hold. If your target share price is more than 10% of your current share price, that's called a buy. This is an undervalued company, you should get in. If your target share price is below 10%, it's a sell. Get out. Okay, start selling your shares, cut back your position. That's how to interpret these buy, sell, hold opinions. Okay, so the idea here is that if they're at today, call it 72, then I pretty much need to be at 79 plus to call it a buy. And if they're at 72, I pretty much need to be 64, 65 or below to call it a sell. And that's how you will make your buy, sell, hold determinations this week and for the rest of the semester on your projects. Questions about that? Straightforward range. Great. So next, what we want to do is talk about the bull and the bear. Because even when we have the targets, and I want to be specific about language here, the target is your opinion. The as is not your opinion. The as is says, I have data in the real world, and I have academic equations, and I'm trying to back solve. I'm working backwards from the real data the real results, to figure out what the assumptions had to be to get those results. That's the as is. When you go to the target, what you're doing is you're putting your opinions into the key value driver equation, and it will create a new solution. It'll create a new price. That's your opinion. And the opinion could be different because even if you look at the market today, not every analyst agrees. Right? So I can't tell you whether your opinion is right or wrong. It has to be somewhat factual based, but there's some differences on point of view. Now, about 5 or 6 years ago, what Wall Street started to also do is they started to include ranges, bulls and bears. Because think about this. If I'm a portfolio manager, the way that I define risk, if you took modern portfolio theory, is standard deviation. It's volatility. So when I'm thinking about the risks of the stocks in my portfolio, I need to know their standard deviations. I need to know the upside and downside risks of these stocks. And that is basically hinting at the nature for a bull and a bear. Because if I interpret this data correctly, SBUX has a lot more downside risk than upside if I buy the stock based on what these analysts are saying. And so I need to know that if I'm telling a fund that they want to get into SBUX, like, hey guys, there's a lot more downside risk here at this price, even though I'm calling it a hold. And you need to understand that. Because to the funds, that range could be just as important as your target stock price. And so Wall Street has sort of adopted this. Right? Now, I'm going to short circuit this because last semester I pulled a trick on the undergrads, and a bunch of them got zeros on their assignments. They already hate me already. You guys hate me already, so that's okay. But the point is, because you don't like the fact that you get in grades, you don't get perfect scores in every grade, so whatever. All right, so it's about academic experience. It's not about your personal resume. But the point of the story is, because this semester, if you get a zero on assignment, you can't opt out of the midterm. I'm not going to do the bear trap for you with the assignment that I did last semester where like 60 or 70% of the class got zeros. And they wrote lots of words. And when you write lots of words and get zeros, you get pissed off. All right? So I'm going to prevent you from doing that by skipping the assignment, but I'm going to tell you why I gave the assignment. You're like, what the hell is he talking about? So basically what I said is pick a company, whatever company it was, this semester would be Yum, and basically write up your bull and your bear. So how high could the price be and how low could the price be over the next 12 months? You establish a range. And what most students did as part of that assignment is they said plus or minus 15%. Okay, and that was their range. And some of them even went so far as to say it was based on historical volatility, and they looked up historical volatility and they said it's based on this historical volatility. And they wrote lots of words to say that, and they got zeros on their assignment. Because to be honest with you, that's useless. Everything you wrote, no matter how many words you just said, if that's all you said, is useless information. And you don't get credit for useless information in this class. Why, from my point of view, is it useless? I'm sorry? It's arbitrary. Why 15 or 20? Why not plus or minus 20%? Why not plus or minus 17%? Why not plus 20% minus 15%? Why not plus 5% minus 30%? It's an arbitrary range. And giving me an arbitrary range as a fund, you just wasted my time. And that's not of any value to me. The problem with historical volatility is the past doesn't always predict the future. If their business model is evolving, their volatility could change. And so we need to understand that when we start thinking about the future. So here's the point. What we're about to do, and this is where people got in trouble, because they basically put in arbitrary ranges, and I told the TAs to give them zeros. So I'm going to avoid giving you that painful lesson. Hint, hint. Remember this on the midterm exam. It'll probably show up as a question. And more importantly, it's going to show up in the grading for the upcoming assignments. But the key here is I'm warning you about this in advance. So here's what matters more. Let's think about the bull scenario. Well, you guys were enjoying partying away on spring break. All hell is breaking loose in the economic markets of the world. Interest rates in Europe went negative. Interest rates in the US inverted the yield curve. The Federal Reserve last week said that they're not going to raise interest rates any more times this year, and they're taking a pause, and they cut the forecast for US GDP down dramatically this year. So what I'm telling you is the warning signs for troubled economies are getting much, much worse in the short run. So it goes back to when I think about my bull and my bear, like I should be using those words when I talk about the bear for SBUX. Okay, so given all these scenarios, if we really get into a recession and all hell breaks loose in these markets and SBUX is in these markets that are having tougher times, this is what we think could happen to SBUX. So I'm not going to put 100% probability in a recession. And what I'm saying is the recession could be actually a recession as opposed to 2.1, but I'm not saying it's beyond the possibility that we head towards a more recessionary period. So what happens to their growth rate? What happens to their margins? What happens to the company if we see this scenario? So let's start the practice. Starbucks, file, save as, bear. This is my bear. So now, let's think about what we want to change. So let's go back to assumptions. I don't think we're going to change the WACC. WACC is seldom changed, especially since we're using target capital structure. There's exceptions to every rule, so I'm not saying you can't change your WACC, but I don't think it's going to change dramatically from this. So I'm probably not going to change the WACC. Now, what else could happen in my bear scenario? And these are things that come to light in the next 12 months that are realistic. So this isn't like aliens show up from another planet type stuff. This is using what you see in the real world and extrapolating realistic impacts to Starbucks. So I'll give you one of them. Right now, almost every Democratic presidential candidate is talking about repealing the Trump tax cuts. If the Congress changes to all Democrat and a Democratic candidate wins, I think we're not looking at 21% tax rates in the future for corporations. So in my bear scenario, assumption, Democrats take back the government and repeal the Trump tax cuts for corporations. So what I do is I come here to my ratios and I say, back when we had higher tax rates, Starbucks tax rate was closer to 32%, 33%. So starting in 2021, I'm going to go back up to 32%. By the way, right there, I'm now to $61 share price. Now I'm in the sell range. All right, and by the way, that's selling the whole market. That's just not selling Starbucks. All right, so if the Democrats win and they repeal Trump's tax cuts, bad things are going to happen in the stock market. But let's continue. What else could happen? Well, the other thing that can happen, you can see this now with historical data, is the EBITDA margin for Starbucks it went up from 21, but it's been relatively stable and improving. Well, let's say, again, what's their beta? I looked it up earlier. Starbucks beta is about 0.7. So this is part of why you're going to do an EIC analysis for your company, because when you go to RV and when you go to markets and you go to beta, the person or people on your team that are writing up the EIC would have explained to the people that are doing the valuation, because these are not independent of each other sections of your projects, that the industry has a 0.7 beta and Starbucks 0.72. So they may not be as affected as the entire market, but they're still going to get a little bit of a hit if the economies start to tank globally. So what does that mean? Well, what I'm going to say is, what if the growth rates are closer to 4%? And what if they don't get the margin improvement? What if they get margin erosion that gets them back to where they were in 2018? Now, I'm not too far off. I'm not saying we're using the analysts as our range for our bull and our bear, but I'm telling you, there's an analyst down here in that range. And I'm saying that his assumptions, Michael Poon's assumptions, probably aren't too far different than what we're talking about here. I'm not saying this is likely. What I'm saying is this is possible for those following reasons. And by the way, you got to write 1,000 words anyways. So here's a nice thing. WACC doesn't change. That's at least 15 words to your paper. It's real easy. Tax rate is going to change. That's at least 30, 40 words talking about your favorite political scenario. So what I'm saying is this is part of your write-up, and those are the 5 assumptions that I want you to focus on right now. You can focus on more, but at least start with those. WACC, probably not going to change. Tax rate, G, growth rate, EBITDA. Those are the core metrics. And those are the ones I want you to talk about as you go through these 4 scenarios. And by the way, you need to list your assumptions as to why. So if you just put into your model the numbers, but you don't explain why you change things, you don't get credit for this assignment or your group project. That's the additional standard of the bear trap that I was talking to you about. Yes, sir. So again, not in a particular order, so I'll start at the top. Growth rate, EBITDA margin, tax rate, WACC, G. Those are the most important things to change. You can change others, but if you just talked about how those change through the 4 scenarios, I'll be happy. And you guys will start to see how those actually have the biggest impact on the models as well. Yes.
Last thing you changed, you mentioned market erosion. What did you change?
What I changed was I lowered the growth rate to 4, which is again somewhat of a swag, and I lowered my operating margin to 21. And this is what I mean by I'm going to do the same thing with target as I'm doing with my bear, is I'm now injecting my opinion. See, when we did the as is, we weren't putting in a lot of our opinion. We do the bull, the bear, and the target. We're now starting to put our opinion, but I've put my pessimist hat on, where I'm thinking, gee, this is a cloudy, rainy day. Okay? And then I'm going to take my happy pill, and then I'm going to switch philosophies. I'm going to do the bull. All right, so there's my bear. So I saved my bear. Matter of fact, it might be easier to open the as is and file save as, because this is kind of your baseline, and then talk about the bull. So here's my different bull assumptions. All right, my bull assumptions are for the top end of the range of SBUX is I don't think that the tax rate is going to change, regardless of who controls Congress. So I think the tax rate's going to stay. I also don't think the WACC is going to change. And I think that SBUX, despite some of the short-term clouds, is growing very rapidly outside the US. And they're also getting into other products like juice and food. And that gives them a lot bigger runway to grow. And hopefully potentially higher margin products as well to sell. So I actually think that SBUX might actually maintain a higher growth rate than the market does into those out years. I'll go 8 again. And I can see that historically, in the good old days, their EBITDA margins were approaching 24, 25%. So I think that SBUX might actually get to a 23% EBITDA margin over the next couple years. And I'll make this 22.5, so kind of step it up. Because I actually do think that they're going to have a little bit of pricing power. In fact, anecdotally, I've been going to SBUX recently. They got new menu items. They seem to be a lot more expensive than their old menu items. So obviously people are paying higher prices. And so at the end of the day, that is a share price. Eek. That is a share price of 78. Now I'm in the buy end of the range. All right? So here's the thing. At the top of my range, SBUX today is trading at about $71 a share, rounding off. In the next 12 months, I think they could be as high as 78. In the next 12 months, I think they can go as low as 53. I've established my range. And I've given you the reasons for why they would be on either side of that range. That's the bull and the bear. Yes?
So you changed growth rate to, and then even 2024 to 23.
Yes.
Anything else that you changed?
Yes. But again, what I am doing here is less important because now we can disagree. Because Professor Perpetuity does not have a crystal ball. I can't tell you exactly what's going to happen in the next 5 years. And so within reason, I can't just mark you wrong arbitrarily whether I disagree with you. Now, what we are going to do is we're going to be realistic. That's what I said. Aliens from another planet showing up and attacking the world is not going to get you any credit, right? Because that's probably not a realistic scenario, right? But nonetheless, you need to base your judgment based on real world data, right? So that will help you. All right, I'll give you a hint that somebody made to me, I don't know if it was the beginning of this class or last class, it's all running together, but they said that YUM, which is your homework assignment, just did an investor day. And they said, when I looked up their investor day presentation, a lot of this data is in there. And I said, feel free to use it. Don't plagiarize it, reference it. But if you can use some real world data to help you understand this, nothing wrong with doing that. But nonetheless, you establish the range. Now, final piece, target. Where in that range do you realistically think SBUX is going to be? That's your target. Now again, I'll go back to last semester. Somebody put a target price above their bull. Right? They got a 0 on the assignment. They were pissed off, but it doesn't make any sense. Like the bull is the best case scenario. So your target can't be better than your best case scenario. Right? Same thing. Your target can't be lower than your bear. Those are your endpoints, your bull and your bear. It's the range. All right? It doesn't have to be a symmetrical range. All right? It can be more up and more down. Matter of fact, that's the point. My bull and my bear, my simplicity says there's more downside to SBUX than upside to SBUX in the way I'm communicating this model. And so the final question is, where do I think they're going to fall against that range? So my personal opinion of SBUX, without looking up too much, which you will do, is that I actually think they are going to be closer to the growth rate with better margins, and their share price is probably going to be somewhere around 74. That's my opinion. I actually think that the tax rates aren't going to change. So I'll repeat that assumption. I don't think the WACC is going to change. I'll repeat that assumption. I don't think the long-term G is going to change. I think that the margins are going to go up and stay a little higher than the base case scenario to 23. And I do think that the growth rates are going to be closer to what the market's expecting. I think that's realistic. That's a 73 and change stock price. Oh, by the way, hold. Plus or minus 10% of the current stock price. My upside, 78. My downside, 53. So I'm not giving you a compelling reason to jump into Starbucks right now. Because what I'm saying is, I think you're looking at 5% returns this year. And best case scenario, I think you're looking at 10% returns this year. Worst case scenario, I think you'd be down 30% this year. So, or 20% this year. So I don't think you should be going into Starbucks. That would be what I would really say. But the point of the story is, you could disagree. That could be okay. But that's your assignment. Questions? All right, so this assignment is 2 parts. So on Wednesday, and we're going to do this in just a minute with McDonald's, I'm going to show you how to update this model. Because as I said before, it took us 2 weeks to create this model. It's going to take us 10 minutes to create this model for McDonald's. If you can't replicate this, you're going to have a lot of trouble later in the semester. So I'm going to show you how to replicate this model to use with other companies. This is the coolest feature of what we're going to do this class. All right. And by the way, just about every class for the rest of the semester, you'll be doing this on different companies. To me, this is the more interesting part of the semester because the academic theory is coming to an end. It's just apply for the next month going into your final projects. So here's the deal. Wednesday, what's going to happen in class? I'm going to give you another company. I'm not going to tell you who it is until the class starts. I'm going to give you 30 minutes, and you're going to replicate everything we just did, including the 4 files, without a write-up. But you're going to turn in 4 Excel files. And if you do that, it's 2% of your semester grade. Okay, so it's an easy 2 points. But you got to do it in class, and you'll have to finish it during class time. Okay, you can't do it outside of class. So my feeling is this room is going to be full. All right, then Friday, you're doing the same thing, except you're going to have 1,000 words. And what's different about Friday is for the EIC, let's go back to Bloomberg. You're going to do for Yum Brands, but I'll use Starbucks as a proxy. You're going to go to RV. You're going to go to the beta, and you're going to look at the beta, the market, the beta. So again, this is division of labor amongst your team. Strongly encourage you to do that. And somebody's going to write up the impact of Starbucks in the market beta, just as like we did in a previous assumption, except you're going to do it for Yum Brands. Then you're going to go to custom, and you're going to do an industry spread based on operating ROIC and WACC. Obviously, it's going to be slightly different because this is Starbucks, not Yums. The competitor list might be slightly different, but you're going to talk about whether or not this is an attractive industry. You're going to explain using the 5 forces why the spread is the spread, whether or not it's going to change over the next 5 years, and then you're going to talk about whether or not Starbucks has a competitive advantage and whether or not that will change over time. All right. Then you're going to do historical analysis. When the model's updated, if you go to the ROIC drivers tab, there's the tree. So the tree for Starbucks / Yum, when you update the model, auto-calculated. You can start analyzing the tree. When you go to the CFI, you're going to analyze the historical years. Okay, there's the historical years. Ignore the forecast years. You can hide them. Don't delete them. You'll kill your valuation. So the CFI is there. The ROIC tree is there. That's section 2. Walk through as you did in the last homework assignment. Then you're going to do the valuation, and you're going to do all 4 Excel models and write up your assumptions. And what's key is the write-up of assumptions. So again, I changed growth rate, EBITDA margin, tax rate, WACC or G. Why did I change them? Why did I use the numbers? Why did I leave them upset? Just a sentence or 2. That's market-based information. That's your assignment for Friday by 5 p.m. You'll turn it as a group. Monday, 1 week from today, I will give you a different industry. You'll pick individually a company within that industry, and you'll basically do a much bigger project on that company for the next 4 weeks. So this is the practice to make sure we're all in sync so you can do your bigger group project. But this is a dry run of the bigger group project. You're doing 3 of the 4 sections. The only section we're missing is multiples. Okay, so it's kind of a decent sized assignment. But again, if you do this one well, you'll be in good shape for the final project. Okay. Questions? All right, last step. How do we build a reusable model? So I'm going to turn Starbucks into an as-is for McDonald's. So here's what we need to do. Save this. So I'm going to go back to my as-is. You could use any one of the 4 files. You could use your as-is, your target, your bull, your bear. I generally like to use the as-is. But regardless, you're going to start with this, in this case the as-is, and you're going to file, save as. Instead of Starbucks, it's going to be MCD for McDonald's as-is. Now, I need McDonald's data. Several people had asked me about this before class today. So, in Bloomberg, in a previous homework assignment, I go to MCD, US Equity. I then go to FA. I then go to Custom. I then go to my model template, which you had to match exactly this semester. I need 6 historical years of data on McDonald's to exactly match so I can copy and paste it in the Starbucks file. If any of the rows are off, if any of the columns off, it's going to break your model. You won't be able to complete it in 30 minutes. So that's why your assignment was graded harshly, because we needed this file to be exact, because otherwise you couldn't do these upcoming assignments. So if you don't have it exact, you need to figure out a way quickly to get it exact, because you're not going to be able to figure it out in 30 minutes in class. You just won't. So basically make sure it's exact. Here's the other thing. On your settings, you can't have more than 6 years. So set 6 years. Also, you want to have under data, make sure none of this other crap is checked down here. If Bloomberg starts giving you extra columns of data, it's going to screw up your model. So don't put those extra columns of data. Uncheck those boxes. And under display, make sure it should already be defaulted to ascending, because you want the most current year on the right. And then finally, make sure you're exporting as value, not as, come on, Microsoft, go away. Stop. Go. Get. Yeah. Okay. Make sure you're exporting as value, because you don't want to export as formula. Because when the TAs grade it, it'll just give you a bunch of gibberish and there'll be no data in your assignment. So make sure you're exporting. Those were the default settings. Hit update. Yes? Sure. So settings, global settings, all these unchecked. 6 periods. Nothing really changes in display. It shouldn't have to. Just make sure you're doing ascending data. And again, report Excel. Values, not formulas. That's the important one here. And again, this is being recorded in video. You go back and check. Once you've done that, export, Excel, current template. Now you have McDonald's data. Oops.
You accidentally clicked not value.
Okay. So cancel. Good example. So let's go back to Bloomberg. Thank you for pointing that out. So you'll get frustrated in here. So under data, display, report. Oh, you don't want that to happen to you. Because like I said, you won't be able to see the numbers. Thank you for pointing that out. So again, hit update. Now, export, Excel, current template, and that's the difference between data and not data. So if you see that error, that's why you're getting that error. Okay? All right. So here's the important part. Save this. File, save as, call it, I usually call it ticker symbol. So MCD data, but call it whatever you want. That's the format you'll see that I'll use. Put this in my downloads folder. Save, replace. All right, this next part is very important. Select this whole tab. right-click with your mouse and copy. Switch to the McDonald's valuation model. Go to the first tab, which is model data. Select the whole tab. Right-click with your mouse. Paste special values. And it will overwrite the Starbucks data with the McDonald's data. Very important that you don't copy paste. If you copy and paste across the spreadsheet, Microsoft will create a link to that other file. And every time you open this spreadsheet, it'll basically say, where's this other data file? And it's just annoying. So you don't want to do that. So copy, paste special, just the numbers, the values across the spreadsheets. You don't create a link when you do that. It's just a simpler way to move data across. Then check. Go to your CFI. If you did it correctly, your CFIs will balance. So I skipped another important step. This is the third time I've done it today, but it's great I'm making the mistakes. What is the other mistake that I made? I didn't get rid of the dashes. So this is what happens when you get lazy and you don't do the dashes. Your model is invalid. This is what I mean by Excel chokes on dashes. I didn't replace the dashes with the zeros before you copy and paste it in. Because if you start doing it in your model, you might actually replace something on another tab by mistake. So go back to your data tab. Thank you for pointing this out. Copy the long slash, because somebody actually copied the minuses, which is really bad because then it'll change the minuses to zeros, which you don't want to do. So copy the long dash, edit, replace, find a replace. You can paste the long dash, replace with 0, replace all. For McDonald's, you replace 25 of them. Then, save your file, right-click, copy, go back to McDonald's. Right-click, paste special values. Then check your CFI, and you should get a balancing CFI. If you don't have a balancing CFI, you don't have a valid model. And one of the reasons you wouldn't is because Bloomberg added a field for a company that's not on that exportable list. You would then have to figure out what that field is and adjust your model accordingly. I think we've accomplished it where 98% of the time you won't have this problem, but we could run into a project across 26 group projects where one of your teams might have to do that. Okay? Real world can't tell you what we're going to encounter. So let's go back to this. I have a valid model. My CFI balances. So now I want to start changing things. What do I change? Start with assumptions. Last reported year 2018. 2018. I'm good. Cash as a percentage of revenue, we're going to leave that at 2%. Next, WACC. McDonald's probably has a different WACC. So this is part of the template I gave you earlier in the semester. So go to WACC. I'll take a screenshot, but it's 6.9. So this is my MCD WACC. So by the way, 6.9. Next, I'm going to solve for the G. Shares outstanding. It's the next big one I'm going to have to change. Got to have a different share count for McDonald's and Starbucks. So DES. File, screenshot, save. MCD -DES. So two things here. Share count, 765.3 million shares. And share price of McDonald's is not 70.80, it's 185.81. Next, EEO. I need to update this data with the current EEO for McDonald's. So go to EEO. Basically, take a screenshot, save. All right, so revenue, first 3 years, $29.07. 2020 revenue, $21,320. 21-22 revenue or 2021 revenue, $22,140. EBITDAs, $10,772. 11,309 and 11,877. EV to sales, 2020, second forward year, 8.09. EV to EBIT, 2020, second forward year, 17.76. There's my margin. Estimating a G. To get to a G, it's obviously going to be less than 4%. Let's try 3. Let's try, let's try 3.7. There we go. 3.9. Actually, was it 4.2? Oh, sorry. Before you do the G, one other thing that it matters, because we're not going to have a realistic ROIC, go back to ratios. I forgot this one. So we need to look up McDonald's tax rate. You look up the tax rate based on the last analyst call. I'll save time. When you look up the last analyst call, they guided to between 24 and 26% tax rates going forward. So I'm going to use the middle of the range, call it 25. Tax rate, 25. EBIT margin, 45.6. So I need this number to be 45.6. I don't know why it's 15. Oh, because this has the Starbucks hard-coded number in it. That's why. This is why you got to be careful when you reuse the model, because when you start typing in numbers to the yellow fields, they carry over when you copy over. So this is one of the problems. So I'll put this in here, get close to the share price. But what I really want to do is I want this to be 45.6. So to get this to be 45.6, I need this to be 52.6. Okay. Then I go back. Might be helpful to just put in a more realistic growth rate, which is probably closer to 4%. Then I'll go back and now I'll do my G. So basically the G can't be 4.2. It's going to be like 3.2. Seven. Close enough. Sorry. All right. Now that these match, back to the ratios. See where I am on price. 185, 240. So I skipped one step. I need to take this 3% G, 3.15, and switch my continuing value G to 3.15. This is what the model's actually using to calculate the stock price. I'm now within $1, close to $1. So I need to basically get a little bit more. So at this point, what is my a little bit more? Well, a little bit more might be basically 4 versus 3.8, and then close enough as is. Right? So from here, save this file as your as is. Explain why you did what you did. Then bull bear. You start with the bull, the bear, doesn't matter, but establish why'd you change each of those up to 5 ratios or leave them the same. Repeat that process for your bull and your bear, establish your range. Then target, put in what you think is realistic for the company going forward. Again, explain the 5 choices that you're making to get to that share price. Save those 4 files, done. Okay. For Wednesday's assignment in class, you won't have to actually write up your assumptions. You'll just create the 4 files and upload them. Okay, it's process. I need you to make sure you can do what I just did. Because if you can't recreate the model, you will not be able to successfully complete the YUM assignment, much less any other assignment for the rest of the semester. So that's why, if you're wondering like why I'm being a stickler to forcing you to do this on Wednesday, this is why. And if I give you forever, that means you might not be able to do it in the future. So again, I'm calling it extra credit, but that's what Wednesday is about. But simultaneously, this is the same assignment for Friday. You know the group project company, it's YUM. And those are the 3 sections. The assignment will go live later today, but that is the assignment due Friday at 5 o'clock. Yes, sir. Sure. All right, any other questions about this? I recorded this on video. It will be available on YouTube, so you can go back and watch this. But again, my strong recommendation today, get in touch with your team members as soon as possible. Because even if you don't have all the valuation models sorted, your team members can start working on the EIC. They can start working on the historical analysis, right? And most importantly, you need to get the data from the lab. So my recommendation, take the screenshots, the 3 screenshots, so your team can get them. And the other thing is, make sure you export the YUM data file, right? Because you're going to use that as you update your YUM model. So very similar to what we did with SBUX, right? So again, even with my anecdotal comments, that was about 15 minutes. So that's what I'm telling you, is that it doesn't take long to do these repetitious models. By the end of the semester, you'll do this in 5, right? And you'll be able to do it with a lot of different companies. Matter of fact, if you got really cool, you could actually, you need a Bloomberg terminal to do this, but you can actually have a ticker symbol and Bloomberg auto-populate. You switch the values, but you got to have a terminal to do that, which is the one thing you don't have. That's why we're doing the copy and paste, right? But regardless, this is the model, and it works, and it's very real world. So that's what we're going to be using this semester. So again, questions? All right, great. See everybody on Wednesday.